Welcome to Moneyness Market Advisors.
So, in the previous videos, we have covered different types of assets that we can invest into. Just like we have different types of assets, investors are also of different kinds. Not all investment options are suited for every investor. Every investor must select investment options based on some characteristics, which are risk appetite, investment horizon, and liquidity constraints. Investors are generally either the ones who love to take risks or the ones who prefer to better avoid them. Investors should first determine their risk appetite and based on that build portfolios consisting of both defensive and growth assets. So defensive investments work as an effective hedge and are generally the least risky investment options. Investments in risk-free government securities and gold are considered defensive investments. These investments tend to hold their value when the economic conditions don't look very favorable and the stock markets are down. Whereas growth investment options have higher growth potential over the longer terms but provide less stable returns, thus are also considered to be risky. Examples include real estate investments and equities. Once we have taken the risk appetite into consideration, we'll move on to investment horizon, which is one important aspect that every investor should ascertain and ensure that the return expectations are in line with the asset potential. After knowing the investment horizon, we'll move on to liquidity constraints. So, as we all know, our life is full of uncertainties for which we ourselves are accountable. At any moment, we should have funds reserved for any unexpected expense to ensure the independence of our investments. Generally, a longer investment horizon allows the investor to have a greater risk appetite and have a major allocation towards growth investments. For example, a person in his 20s has a 30 to 40 years of investment horizon to plan for his retirement. Thus, initially his major allocation should be in equities. And as he approaches retirement, he should gradually shift to defensive assets such as government securities, bonds, and maybe a small portion of blue chip equity shares. The risk appetite also depends upon the flexibility of investment goals. You can postpone the purchase of a car for 2-3 years, but you don't have the same flexibility with your future study plans. So you can take higher risk on your dream car portfolio, but you need more certainty in the growth of your further studies portfolio. So do you think equity investments are best suited for you, but don't know what it actually is? Or how can you even buy shares? Let's figure this out next. Stay tuned.